Historically, Bitcoin has been one of the purest liquidity plays. So when you look at various measures of domestic or global liquidity, when liquidity is rising, that's pretty good for Bitcoin, and when liquidity is falling, that's usually Bitcoin's usually either going down or sideways. And starting around the beginning of Q4 of last year, some of the liquidity indicators started to bottom and turn back up, at least temporarily. And I think that, much like other assets had a rally, I think Bitcoin would have had a rally back then if not for the whole FTX debacle. Uh, and so that kind of delayed the rally, but with that somewhat resolved, and now kind of moving forward, I think Bitcoin and other aspects of the ecosystem are kind of having their rally, which is really a liquidity rally.
Welcome back to Market Empire. Recently, well-known macro analyst and investment strategist Lyn Alden shared her thoughts on the current cryptocurrency rally and how long she thinks it will last. Alden explains her view that the rally from a macro perspective actively has more influence on the prices of crypto assets and core metrics like the 4-year holding event in an interview with Natalie Bruno, host of the Coin Stories podcast. She explains that the current Bitcoin rally, which has the cryptocurrency trading near 5 monthly highs at a time of oppression, is a delayed reaction to a change in global liquidity, similar to what the stock market experienced in November. Here is a link to Alden's interview, in which he answers some very interesting questions about Bitcoin and the global liquidity cycle.
And I think that, much like other assets had a rally, I think Bitcoin would have had a rally back then if not for the whole FTX debacle. And so that kind of delayed the rally, but with that somewhat resolved, and now kind of moving forward, I think Bitcoin and other aspects of the ecosystem are kind of having their rally, which is really a liquidity rally. And so, basically liquidity indicators look okay for the next couple of months, but overall long term, they're still not in a very good place. The market kind of assessing that the Fed's getting close to being done its hiking cycle. And so that's kind of what happened last time, where when the 2-year rolled over the Fed funds, that ended up being the top of the hiking cycle, and that ended up marking the bottom of Bitcoin. And so right now, I think we're seeing shades of that. It doesn't mean that it's the exact bottom. It doesn't mean that the bottom's guaranteed in. But I do think that the part of the downward move in Bitcoin that was specifically from the dollar rally, I think that's kind of behind us. And now I think we probably have a longer grind ahead of us to, kind of start rebuilding from here. But I think when you look in the second half of this year, there's still some liquidity concerns. And so kind of like how in the prior Bitcoin bear market, you had the major bottom in, say, late 2018 into 2019. That was the big bottom. But then you kind of had like a later liquidity shock through March 2020, where you went down and went up much faster. It was again, another liquidity issue. I would be surprised if something like that, like a sharp retest, but it's too early to say because it partially depends on what humans do, what Jerome Powell does, what different policymakers do, and of course that's always impossible to predict. But overall, like historically, Bitcoin has been very correlated to macro factors and specifically liquidity. And I've looked at it over the past couple of years because a lot of people they look at the halving cycle. That's obviously got some degree of correlation. But then if you look at, say, Bitcoin and the Purchasing Managers Index, which is one of the leading macro indicators, generally when it's rising, it means the economy is expanding, growth is accelerating. When that's going down, growth is decelerating. It goes below 50, it's potentially outright contracting. And generally, Bitcoin's rather correlated with PMIs. It usually runs a little bit ahead of PMIs, like it usually front runs it a little bit. And then I looked at it and saw that basically liquidity generally front runs PMIs, and Bitcoin tends to be very correlated with that liquidity. And so for the past 3 cycles or so, it's already been somewhat of a macro asset in that sense. But of course, if you have a big enough industry-specific blow-up, like we saw with FTX and like you might see with some of these others, that can temporarily override the macro factors because it doesn't matter if liquidity is good if there's some massive forced selling whale out there.
I wanted to ask you, Lyn, what are some really big threats to Bitcoin?
So there are a lot of ways to slow it down. I think that the lowest hanging fruit would be to cut it off from the banking system. And so, the way that, say, in the United States, we have the First Amendment, and we have other kind of protections that have been successfully used to, defend the use of encryption, defend the use of code as speech, right? So it's pretty hard to tell people that you cannot run a full node open source software, that you can't, memorize 12 words, that you can't, flip a coin 256 times and generate a private key, right? It's very hard to enforce on that level. but it's really easy to tell banks that you can't send money to crypto exchanges or brokerages, or fiat on ramps into Bitcoin and crypto and things like that. And so that's kind of the big lever that could be pulled by the United States, by Europe, and by some of these other major countries. And it depends in part how short-sighted politicians are, right? Because on one hand, they might want, to pull that, and be like, no, we're going to defend ourselves against this like rising like decentralized currency. We're gonna shut off the on ramps to it, but then you also drive out businesses from your jurisdiction, right? So if the United States does it, but Australia comes out or another country comes out and says, build all your businesses here, then it basically, in the long run, is probably not going to be good for that. We saw, I mean, back in 2018 and for years since then, India was exploring that, right? They were like, kind of flip-flopping between maybe we should ban all this.
Mm-hmm.
And then it's like they kind of realize like you don't actually ban it, you just ban yourself from it, which can maybe work temporarily, but it's not really a good long-term strategy. And so overall, I think that the biggest impediments are just restrictions on privacy, attempts to make it harder to self-custody your asset, as well as kind of the potential giant attack would be to severing it from the banking system. But that would be that'd be a pretty major event. Most of the indicators point that we are like early stage recession or late stage expansion. And so a lot of the leading indicators, like conference board leading indicators, purchasing managers indices, those things are rolling over. Industrial production's rolling over. Inflation adjusted retail sales are rolling over. And the strong area, as you point out, has been the labor market. Historically, that is a lagging or coincident indicator, meaning that by the time unemployment is rising, you're usually already in a recession. And that's part of the reason why those two negative quarters weren't kind of a full recession, is because unemployment was still pretty low and not really worsening yet. Even in the labor market, though, we're starting to see that some of the early indicators there are not looking good. So, for example, if you look at overtime hours, those are on the downtrend. If you look at temporary help, that generally is a more volatile and leading part of the overall labor force. Because imagine if you're a small business and you're running into tight times, you might reduce your temporary help service before you would let go permanent employees. And so those are actually down year over year. And so basically there are multiple small signs that the labor market's cracking, which combined with all the other indicators, inverted yield curve, contracting PMI, it kind of points towards likely recession. But I think we're still in the kind of either the pre-recession stage, or they always declare a recession months after it happens. So it's possible that this is like already part of the recession. But if it is, we I think still really early stages.
And how are valuations looking? Because I know that there was a concern about equities earning multiples last year, but now it's more so corporate earnings for this year, right?
Yeah, so 2022 was a story of earnings multiple contraction. So it's not like earnings went down yet. Basically, you had some non-energy earnings fall a little bit. That was offset by energy earnings. So overall, S&P 500 earnings are currently fine. But you had because you had a sharp rise in interest rates, you had a sharp reduction in valuations. And one simple way to think about it is if usually the 10-year treasury is like the benchmark that you compare equities against, right? If you can get a 6% yield on a 10-year treasury, you might look at equities and say, I'm only going to invest if I can get 5% better than that, right? So I want 11% expected returns, therefore I need to buy them pretty cheap if I want to comfortably beat the treasury. On the other hand, if the treasury is yielding 1% and I still want a 5% equity premium, I might buy equities even though I only anticipate that they're going to give me a 6% return, and therefore I'm willing to pay more like a higher earnings multiple, lower dividend yields, things like that. And so as you've seen a sharp rise from your zero yields all the way up to well over 4% at one point, that put a lot of downward pressure on equity valuations, especially growth-oriented equities. And I think that part of the story is now largely behind us. And the question for 2023 is, are corporate earnings themselves going to be very weak? And I think that, I don't think they're going to collapse, but I do think that they're going to be weak. Yeah, I think 2023 is a transition year, just like 2022 was. So basically, 2020, 2021, you had this huge injection of liquidity. 2022, 2023, they're trying to pull some of that out. And I think you have to really kind of probably look into 2024, 2025 until you might see another round of liquidity. Now, these things are subject to change because it's based on actions we can't anticipate yet, human decisions. But generally, I think it's like this is a year where you want to build a good base, whatever it is that you do. You want to build a good base, whether it's a financial base, whether it's something you're working on, build that base and just kind of survive. Basically, don't necessarily expect things to boom this year. And it's going forward into the next cycle is when you want to have whatever you're building ready to go.
Put your questions and thoughts on Lyn Alden's video in the comments section, and we appreciate you tuning into Market Empire. If you enjoyed this video, please give it a thumbs up, share it with your friends, and subscribe to the channel.